FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz, and today is November 20th, 2019. Well, markets keep hitting new records. Gold, silver not doing so good. The rest of the world doing really badly. What does it mean? What do you think it means? Email us, kl@kerrylutz.com with your opinion, and whether you're listening to this show on YouTube or a podcast site, just click like, subscribe, and share. It really helps us a lot when you do it. Well, Nick Santiago is with us now. You're probably familiar with Nick and his incredible forecast, his record. He's been on the money, and the name of the site is inthemoneystocks.com. Nick, welcome back here. So where are we now? What's going on with the market? Can it keep hitting new highs, or what are we going to see here?
Yeah, you can keep hitting new highs, actually, as long as the light volume remains. And that's something the last time I was on your program, I think we talked about. And I said to them, your listeners, I said, as long as there's light volume in the market, you got to give this market the upside bias. Until there's a heavy volume reversal day, these markets can continue the trend, and the trend is up. And that's really the bottom line. So let me just explain real quickly what heavy volume and light volume is, just so that everybody knows. If you take a look at a spider chart, the SPY, that's the S&P 500 ETF, you're going to notice every day we trade generally between 40 and 50 million shares. That is light volume. If we trade somewhere upward of 85 million and higher, and we reverse on the downside, that is when you have to be very, very careful. So just to give everybody a heads up, that's kind of how it works. It's just that simple, really. So
that's going to be the canary in the coal mine, isn't it?
Yeah, pretty much. You know, I've just rattled off about 15 winning trades in a row since September without a single loser, just sticking with this theory. And there's really no reason to change it until it tells me otherwise. And the bottom line is that right now, you had an early October low. And you're going to notice the volume on that spiders on that day was about 85.9 million. Since then, we're trading under 50 million on average every day. So that's all you need to know. When you get light volume, that favors upside, favors a buoyant market. Even when you get sell-offs, you'll see these intraday sell-offs that occur, even this morning, and then the markets come right back. And it maybe it has a lot to do with the Fed, printing $60 billion a month. I don't know.
You think that might be a factor in things?
Yeah, that might have a little bit to do with it. But the reality of it is, until you get that high volume sell off, you want to stick with that trend.
So the trend is your friend. And the way that you figure out that the trend no longer is looking at those spiders, it's SPDR. That's the ticker symbol. And when they turn down on high volume, and the odds are it's going to be extremely high volume when they do turn down, because it'll be a hallelujah moment. Everyone will be dumping their stocks. Then it's look out below.
That's right. That's exactly correct. And you're going to see, if your listeners just go back and they look at a chart, all they got to do is pull up a daily chart, and you'll see every turning point that we've had. And we've had, 3 major turning points this year. We had one in May, right at the start of May. We also had an end of July turning point. All of those turning points occurred with high volume on the sell side. So until you get that, you stick with that trend and you let the markets go higher. Once you see that high volume reversal, that's when you start to get cautious and you position yourself more defensively, or you just sit aside and let the Fed come out and let the central bankers print more money.
Yeah, well, that's what they do best, right?
That's what they do best.
I mean, that's about the only thing they do. Well, then they slow the flow down a little, but they're always printing, let's face it. So repos kind of stabilized. The Fed has just made that an official Fed-supported market effectively, right?
Yeah. They've actually made that now a new program, and they're going to inject $60 billion a month. They're doing these repos each and every night. I have a strange suspicion, though, that the Fed knows something that is not being told to the public, and I don't know exactly what it is, But, if you look at Europe, you look at Japan, those markets, they have negative interest rates there. So, who's going to lend from one bank to another? So you have these banks that have U.S. Arms to them, these branches here in the United States. I have to think that, the Fed is probably trying to protect some Japanese or European bank. My suspicion would be Europe over Japan, but that's my gut feeling. I don't know for sure if that is the case, but just think about it. These banks are not willing to lend to each other, and when they do, the repo rate, flies so much higher than the Fed funds rate, which is, around 175. And, when that repo first started, I mean, yields jumped over 10%.
Yeah, so, which is unheard of.
There's definitely something bigger going on there, but we'll find out about that in about 6 months to a year.
Well, Martin Armstrong's theory is exactly that. It's a Deutsche Bank moment or something like that. Basically, what Chase Manhattan Bank is saying is, we don't trust the people we're loaning money to even overnight. We're just not going to take the risk. And they've reallocated funds away from the repo market, which has meant that the Fed has to step in. It goes back to Harry Brown, great economist. He coined the term accommodating loser. The government is always happy to step in and lose money if it is going to provide stability to the markets. Other reason why I believe you're correct, and I don't want to go into the whole tinfoil hat precious metals manipulation, but recently it's been so clear that there's external forces at work in precious metals driving them down right when they were about to break out. And the last time we saw that was back in 2009 and 2008. We saw kind of very similar anomalies in the precious metals markets. And shortly thereafter, we found out why.
Well, I have a little bit of a different take on the precious metals right now, simply for the fact that I love what they're doing. So if you just take a look at a chart of, say, gold futures, what you'll notice is that we put the peak in early September. And we made some subtle lower highs. But when you move that chart pattern over to a monthly chart, this is probably the most bullish formation I've seen in gold that it is making in years. So I actually love what gold is doing. I love the fact that it's being suppressed. I love the fact that it's just going sideways. All you have to do, and this is something I tell my members each and every night, is just look at the monthly chart. And I show them that monthly chart, and you'll see this is the fourth month now that we've stayed underneath the peak. And that's what you want to see. After, several more months occur, this thing is going to scream to the upside. Remember, everything has an ebb and flow to it. It moves up, then it pauses. So we used to say in the 90s, we used to call it thrust, pause, thrust. And now, it's the same exact thing. You'll see it in charts going back hundreds of years. You can find charts thousands of years old. You'll see the same exact pattern. It's just a form of human nature. But gold had such a surge from below 1,200, which I believe it was in August of 2018. It was at 1167.
That is correct.
And then we just went up to a pivot high in September, all the way up to around, I believe, 1566 or so. Now it's just consolidating that monthly gain. And when a chart does that, Kerry, take my word on it, it is ready to soar down the road. It's just not ready yet. It's almost like boiling. When you put that tea kettle on the stove, it's just got to take a little bit of time, and then the boiling happens and the whistle goes off. It's the same exact setup.
Yeah, I don't doubt it for a minute. And like I say, the suppression there, it certainly appears to be going on almost daily. And I just see when this thing breaks out, it's probably going to be December or January, according to seasonal trends, but maybe a month or two later, perhaps. But it looks like an incredibly bullish time here for precious metals. So interest rates, what do we see here in the interest rate market?
FSN Radio. It's all about what's next.
Otis Gold Corp is a gold development and exploration company with quality projects in the pro-mining state of Idaho. Otis's flagship Kilgore project has a resource of 961,000 gold ounces, and its recently published preliminary economic assessment demonstrated an impressive post-tax IRR of 53% at $1,500 gold. In addition to the significant expansion potential at Kilgore, Otis is exploring its highly prospective Oakley project. This Carlin-type gold deposit already has an inferred resource, and previous near-surface drilling intersected 123 meters of 0.69 grams per ton gold. Otis Gold Corp trades in New York under the ticker OGLDF and in Toronto under the ticker OOO. That's triple O. To learn more, go to otisgold.com. That's otisgold.com.
The Financial Survival Network. It's all about what's next.
Well, you remember at the lows, I was telling you that I thought interest rates were headed higher, and I'm still in that camp. So right now we're getting a pullback now in yields, and I do think that is going to continue for a little bit. But when the 10-year gets down to around 165 or so, watch for bond yields. They're about to make another big advance to the upside, and I think you'll see that happen very, very quickly once it gets started. But right now I would expect bond yields to pull back a little bit more. But what I've done as far as my mathematics are concerned brings me down to 165 on the 10-year, and then we start to move up again.
Yeah, that's going to have an impact on the market, and dollar stays strong, huh?
Yeah, I mean, I've been, the ultimate bull on the dollar forever now, since the lows in 2018. And even if the dollar does pull back, I mean, right now the dollar's sitting at around 97.70. Should the dollar pull back, I mean, you have monster support. I use the word monster at 96 on the U.S. dollar index. And for your listeners, the dollar index is the U.S. dollar versus a basket of 6 currencies. The most heavily weighted in that basket is the euro. So it'll generally do the exact opposite. The euro chart will look exactly opposite of the U.S. dollar index chart. But the dollar should remain strong. I'd love to see the dollar pull back to 96. I'd go all in there. And, I think ultimately new highs in the dollar down the road.
Really? Amazing. Well, it's always a mistake to bet against the dollar, certainly in these situations where it's been in a multi-year bullish, upward market. But what do you think it would take to bring the dollar down?
Well, they're trying to bring the dollar down now, right? So just think about the Fed doing, the third rate cut this year. And that's something, we talked about when nobody was talking about rate cuts. I think in February or March, I said they're going to cut, right? So they're trying to bring the dollar down. The dollar's just not going down because it's the best. Not only is it the world's reserve currency, but just think about it. If you're in Europe and you're wealthy, you want to have your money in euros. Or if you're in Japan, do you want to have your money in yen? Of course not. You want to have your money in dollars. The safest equity that there is if you're in the currency market.
So what about the underlying U.S. economy? It seems to want to go into recession, but it's just not happening.
No. I don't see a recession right now for the U.S. economy. Now we get into latter part of 2020, get to 2021. There's going to be a recession, but we're not there yet. I don't even think we're close right now. So.
And you've always said that, right?
Excuse me?
You've always said that because that's going to figure in Trump's reelection. Yeah,
I've always said that, and I'm going to stick with it. And more than Trump, it's just the cycles. It's just the way the markets work out. So, the cycles don't tell me that we have a recession on the horizon. You might get a low print in GDP. I mean, we can't argue that. Market's always susceptible to a quarter or two of, 1% growth or something along those lines. But I don't see a recession at all.
No, I'm inclined to agree with you because I think it would have happened already had it was it going to happen. And it's pretty amazing to see that, well, again, it's like we talked about before, it's the Taj Mahal of Baltimore. And like, where else do you put your money? If you're like a major money market, major money manager, you manage other people's funds. Are you going to keep it overnight in Deutsche Bank, or you going to throw it over to JP Morgan Chase or Citi or Wells Fargo or BOA, right? It's kind of a no-brainer on this, isn't it?
No-brainer. A no-brainer, and that's what's happening. And, people think that the dollar is so great. It's not, has nothing to do with it. It really is a Taj Mahal of Baltimore, and that's the bottom line.
Yeah, ain't that the truth, boy? But, yet people never learn these things. And we got thousands of years of history, or at least hundreds of years of history, where the reserve currency of the world, when you have one of these credit busts, I don't know if you watch Bob Hoy or not, but Bob is a big student of financial economic history. And he's traced it back that every time there is a credit bust, and that's what we had in 0809, and that's probably what we're going to have again, the reserve currency outperforms every other currency because even if it's not safe, there's a perception of safety and its liquidity, because really what's more important than safety is liquidity, right? When you want to get in and out of investments, whatever, and you have to look to the reserve currency. That's going to lead until some external event occurs and it gets dislodged, right?
That's 100% correct.
Yeah. So oil is still hitting the skids. We talked about that before. There's no real hope in sight for it. I'm kind of like an electric vehicle proponent, but I don't think that's what's going on with oil right now.
No, right now, I mean, last time I was on your program, I said $58 level was the ceiling.
Mm-hmm.
Just look at yesterday. It was 58.02 or 58.05. That was it. Now, today.
Ran out of gas.
Ran out of gas. Now it's at 55.5.
Pun intended.
So, no pun intended. But, the levels are the levels, and they just really are very, very accurate when it comes to energy and oil. And, you could see, it was a while ago, but I said, they'll take this thing to 58, but 58 the ceiling. And sure enough, now we're down at 55.5. But we're in a range. So the low end of the range for crude oil right now is around 52. And the high end of the range is around 58. Maybe if you overshoot it, 59, but that would be about it.
Yeah, a little bit. It hit 60. We got to think about it. So anything else, any other markets we should be looking at here and paying attention to?
Well, right now, we're coming up into the Thanksgiving Day holiday, so you got to remember seasonality trends are in play as well. You also have an administration now that really is, anytime the market falls just a small smidget, they come out and they talk about a trade deal and, how things are going so well. So, there's a little bit of propping going on in this market too, and I think you just got to take that into account. Volatility has fallen off a cliff, so that keeps me a little bit concerned when volatility is so low. But for the most part, markets are holding up. But like I said at the beginning of our conversation today, watch the volume. It is a leading indicator. It's real time. And if these spiders, the SPY, which is the S&P 500 spider ETF, if that declines on heavy volume, then you get really, really concerned.
Yeah, that'll be the canary in the coal mine, as it were. Well, Nick, always great to have you on. So make sure you check out Nick's site, inthemoneystocks.com. Check us out, financialsurvivalnetwork.com, newsletter free, and social media at Kerry Lutz. That's the Twitter feed. Financial Survival Network, that is the Facebook page. And please subscribe, like, and share wherever you're hearing this from. It really helps us a lot when you do it. Nick, we'll touch base next month. Thanks so much.
Thank you.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.